The diversified trust and property group Emira Property Fund reduced vacancies in its direct South African portfolio while increasing tenant retention rates to 86%. For this interim period, the company increased its dividend up 8.8%. Joining me now for more is Jeff Jeanette, CEO of Emira Property Fund. Jeff, I see you're now paying an interim dividend after deferring. What has changed?
So I think our confidence level in how our business has handled the last 2 years is much higher now. I think we can see where the future is going to be. The major disruptions of the lockdowns and the pandemic and so on is not over yet, but I think we can see our way through now, and that's why it's given us the confidence that we didn't need to at the half year end hold back any portion like we did 12 months ago, just 5 cents. And so we're very confident in terms of actually paying out the 56.5 cents through to our shareholders being their share of the net rental income and profits that we've made over the 6 months.
And Jeff, I'm looking at your statement here. Client retention, 86%, lease extension, 2.8 years on average, occupancy rates, and that was quite interesting for me. Retail, 96%, office, 82%, industrial, 97%. Have we turned a corner? Are we back to a sort of normalcy at the moment?
I don't think we're back. I think you need to look at the individual sectors. So under the office sector, we're sitting with 82% occupancy, and this time 2 years ago, we were sitting at a 92% occupancy. Whereas under the retail side, 96%, we were pretty close to that level 2 years ago. And under the industrial side, for the first time there, we're sort of sitting basically back at that pre-COVID level. So I think you've got to look at it from a sectorial side. We're not fully back yet, but the individual sectors are showing slightly different growth. And there's an advantage of being a diversified fund in that, if you've got too much exposure in any one particular sector, you're going to get over-rewarded or hurt a bit too much. So that's certainly helped in terms of our strategy. And we've seen it so that overall, if you look at it combined, we have a 6.1% overall vacancy rate, which has improved from where we were 6 months ago.
And I guess the other thing, especially looking at your South African operations, is the rising interest rates. How has the cost of financing been factored in to your business?
Yeah, so we're conservatively geared. We've got 41.8% loan to value, which is a percentage of our debt relative through to our assets. We've got meaningful cash reserves. Our bankers know us and understand us. Our values of our assets are realistic. And so we haven't really seen much impact coming through from rising interest rates. Also, close to 78% of our interest rate exposure is hedged, and that has a duration just over 2 years, an average duration. So even though the yield curve is quite steep and there's anticipating some meaningful interest rate hikes this year and maybe into next year, I don't think that's going to play out too heavily and impact us that much for the next year and a half, 2 years.
And in terms of growth for the South African market, where do you see the biggest opportunities?
Yeah, so from an opportunity side in the South African market, it's challenging without doubt. We've got some serious constraints in terms of electricity. Probably on the water is coming next, and the infrastructure on the municipality side. So offices with their structural oversupply at the moment, it's going to take a while. So we're not seeing any particular opportunities on there at all. Retail is a solid performer and is holding its own, provided you're invested in the right centres. And then on the industrial side, that's picking up nicely. It's back to that level. I don't think it's the smaller industrial mini and midi units that we invest into, those sort of industrial parks. I don't think they're too exciting, but they hold their own. They're solid performers. They just tick over. The growth rates are low-ish, but they just keep on going, and for us, that's important.
And Jeff, you mentioned in the beginning an increased level of confidence in the business. I want to talk about the increased level of confidence in the industry and the sector as a whole. So the president is considering lifting the state of emergency. How important is that in lifting, business confidence in the property sector?
I think that's very important. I think it's absolutely the right step, and I'm pleased that we the alert levels have been reduced, because there's one really key thing as a business person. You have to have certainty in terms of what the future environment is going to look like. And it's difficult to look into a crystal ball and say that's what's going to happen with COVID, and maybe there's a fifth wave, maybe there isn't. But if we've got certainty that the state of emergency is lifted, that it is business as usual, that it's an investment into infrastructure, then that starts to release capital. It starts to release people's restrictions or concerns in regard to investing into our economy. And for me, that's a mind shift. And if we can get to that, I think then that the naturally resilient South Africans that are solution orientated, that work really hard, you're going to see that coming out when there's a bit more certainty in terms of the way our economy will play out over the coming years, and the way government is going to handle this pandemic.
I like what you're saying there, Jeff. That level of certainty is certainly something that would help all of us in this season. And now, looking at the property sector and your business specifically, is there room for acquisitions?
There always is, so long as those acquisitions make sense. The only part that we're seeing being particularly attractive at the moment is on our offshore side. We've got investments into the US that now comprise close to 15% of our total assets. I've just returned recently from the US, and I must tell you, it's a very buoyant and strong economy. And so we're hoping that we'll be able to fulfill some of our ambitions, our further ambitions, by investing further into the US economy, giving us diversification, but into a stronger economy. On the South African side, there's always the potential for acquisitions, but you've got sellers on the one side that aren't willing to trade out of their assets at the prices that buyers feel are appropriate. So I think from a South African side, for the time being, I think it's going to be slow progress, slow adjustments to what we've got. And whereas, for example, in the US, I think you'll see a little bit more action taking place on that front.
Brilliant. Well, thank you, Jeff. Look forward to seeing how the year pans out for you. That was Jeff Jeanette, CEO of Emira Property Fund. Let's now take a short break, and after the break, we'll be talking all things CPI related.